continuing with our little Everything You Need to Know series on all the strategies that we deploy in our trading. So we're going to be taking a look at iron condors today and give you everything you need to know on iron condors. So an iron condor, it's a delta neutral option strategy. It's made up of a combination of a short out of the money put spread and a short out of the money call spread. If you've heard condor before, it's the same sort of setup as a condor, but you're trading all out of the money spread. So a condor would be like an in the money call spread, long call spread with a short out of the money call spread. Iron condor is just out of the money option. So you replace the long spread with a short opposite spread, so a short put spread instead of the long call spread. Setup for these trades. So of course we're looking for high IVR high IV and high implied volatility. Your net short premium, you're selling two spreads. You want to be selling as juicy a premium as possible. So we want that implied volatility to be high. Typically, we're looking to sell that around, one standard deviation to up to the 30 delta option for the short option. It's there's no perfect strike. It depends on your risk tolerance, depends on how much capital you want to deploy, but we stay somewhere in that range from the 16 to 30 delta for the short option, and then the width of the spread depends on how much capital you want to deploy.
All right, everybody, we're back for another Rising Star show. Khalid, how are you?
I'm doing good, Tom.
Alrighty. So in today's video, let's talk about how to manage losing iron condors. Already on both sides, right? So this is an iron condor. When you manage it, is significantly much better than if you were to hold to expiration, right? You can see that as time goes past, right, you trade past around from 2011 all the way to 2018 and so on, 2020, you can see that the performance of the 21 days expiration really outshines if you were to hold it to just to expiration, right? So that is the reason why I generally manage my options at 21 days to expiration. All right, so what do you do if it's outside the break-even at 21 days, right? When there's still more than 21 days to expiration. Basically, when there's more than 21 days to expiration, you pretty much just do nothing, right? Just let the trade work out, let theta decay work in your favor, and you never know, right? The market can always come back up. If you were to manage too early, then guess what? You have removed the chances of you being profitable because you didn't give enough time for the trade to work out. Don't forget, when you are putting on an iron condor, you've already got the long option in place, right? The long option basically already limits your maximum risk. So if the market goes to zero or it shoots all the way to the moon, you don't have to worry because you already have the maximum loss defined in place. You already know what's the worst result that can happen. And when you put on this trade in the first place, this maximum risk should be based on the capital allocation that you are comfortable with, right? That you are certain that, even though if you hit the max loss, it's not going to destroy your account, right? So that's why it has to be a small percentage of your account, okay? So what do you do if there's less than 21 days left, right? If there's less than 21 days left and your break-even points have been breached, well, the first thing that you can do, the first option, the very simple option to do is to simply just take a loss, right? This is actually my default option and the one that I like best because for me personally, I have many trades on, right? I can be managing up to 20 trades at one time on the same product, on the same index ETF. So for me to manage every single one of them is going to get so confusing, right? You want me to manage this by closing this or turning this to the different trade or to roll this in and out. It's too confusing for me, right? I'd rather just take my loss. So one thing that you want to understand is that you will have losses, right? So if you were to take a look at the P&L graph, you'll notice that you have a pretty high win rate, right? This is about 85%. But this doesn't mean you're going to win all the time, right? There are chances that you're still going to lose, right? There's 10% chance you're going to lose on the upside, and there's about 5 to 6% chance you're going to lose on the downside, right? But I know that I'm going to win the majority of the time, so there's no need for me to make sure that every single trade turns out to be a winner. If that trade at 21 days is a loss, then guess what? I'm just going to close it out, take the loss, put on another trade again. So that's the first option that you can take, the very simple one. By the way, if you like this video so far, please subscribe and also realized move. So that means that if you were to trade the expected move within the 45 to 60 days to expiration date, more often than the 68% suggests, right, you will be profitable. All right, so this is all theoretical. So how does it actually plays out, right, when you expected move? And then I'm going to show you the results, and we'll take a look together to see whether is it true that, you know, it's where it's supposed, or is it lower. By the way, this video has been so I can create different option strategies that you can use to trade the expected move. So for this, what I did is I traded the strangles. All right, so in my previous video, I talked about the top 3 most profitable market neutral trading option strategies, right? So basically, it doesn't matter where the market goes, as long as it stays within the expected range, then you are able to profit, right? So if you're not sure what the strangle is basically just a short call and a short put combined together. All right, so let's, for example, you just take a look at this price down here. So what you want to do is you sell a call above, and then you want to sell a put below as well. So basically, where you place the strikes is where the expected move is, right? So for this, what I did is that I tried to place as many strangle trades as possible. I placed it at different dates, different prices, different expiration dates, to try and get as many trades in as possible so that the probabilities will work out. So as you can see, this is all the strangles trades that I did for 2022. All right, 2022, as you can see, there are winners and there are losers, and there are quite a number of losers down here. All right, this is where the market, right, became more volatile than what the actual implied volatility is. But at the end of the day, as you can see, it was profitable, right? So for this strangle, because as you know, this is a naked option strategy where you have a naked call and a naked put. I did not want to hold it all the way to expiration. So for this, I got out at roughly around 21 days to expiration because I did not want to gamma to pick up. So whether it's a win or a loss, I would just get out at around 21 days to expiration. So here's the summary. So total, I did about 68 trades. And then there were 46 winners and there were 22 losers, and the win percentage is actually only 67.65%. And interestingly enough, it's basically what the probability suggests, right? The probability already suggests that it will be 68%, and that's exactly what I did, and I did not actually get anywhere near 85%. And the reason for this is because there's not a large enough sample size, right? So for any statistical significance, you need to at least have a couple of hundreds to even 1,000 trades for the probability to play out, right? It's just like you flipping a coin, right? Whether to get heads or tails is a 50 easy for you just 3 times. But does this mean that the coin, because if you were to flip a coin, we will start to go to many trades that comes in. Now, the second thing to note is that although we only had a 67.65%, at the end of the day, we were still profitable. So it doesn't mean that if your probability is around the same as what the probability suggests, as long as you manage. So theoretically, the loss can be unlimited. But probability-wise, that is highly unlikely. In fact, the biggest loss would most likely just be 2 standard deviations. For this trade, the broker would suggest could be the maximum risk. Now, of course, there are times where you're going to lose much more than that, especially like during the COVID crash. But that is why you need to keep on putting all these trades on, right? Keep your position sizing small. So as you can see for this, all these are pretty small. Relative to my account size. So as you can see, the biggest loss is only $1,495 So this is where you can control the losses when you do hit the losses. So you can see from the stats down here, my biggest winner is 425, and then the biggest loser is $1,495. Now, this is something that's very common for undefined risk trading strategies, right? For option trading strategies that's undefined, because when you have a option trading strategy where the probability of win is quite high, most of the time you're going to have smaller winners and then you're going to be much bigger losers, right? So although your loser is much bigger, it's being compensated by the high win rate which you have. So most of the people, or rather most traders, are just used to having big winners and then many small losers. But in this sense, right, this is the opposite, right? You're going to have many small winners, but then you're going to have the occasional big loser as well. What's important is that at the end of the day, as long as you're profitable, then that's what matters. Okay, so you can see the average winner is about $249, but the average loser is actually not too far off. It's about just only about $30 or so, slightly more than the average winner, and that's because the number of losers which you have is going to be much lesser. So when you average them out, your average loser is going to be actually much lesser. So let's calculate the expectancy. So if you're not familiar with what expectancy is, basically it's a way for you to calculate and see whether your trading methodology is actually profitable, right? So for this, the expectancy, the way you calculate is basically the percentage of the win rate times the average winner minus off the percentage of losers times the average loser. So you can see it all pans out to 77.61. That means on average, every time I put on the trade, I should be expecting to make $77. So let's say if I actually, you can see overall, this is a profit. Now, there is another way that you can actually trade the expected move, and the other way is using what's called the put ratio spread. Now, the put ratio spread is the put ratio spread, and then you use the credit from here to finance a debit spread, right? So basically, you have a put debit spread here where you have a put option and then another short put. So total, you have 2 short puts and then 1 long put. So this makes the put ratio spread. So if you were to take a look at the risk graph, the risk profile of the put ratio spread, it will look something like this. All right, so as you can see, there is a 10 shape somewhere down here, and the market price would be normally somewhere around here, right? So this is where normally the market price is. So as you can see, there is this 10 shape here where the profit will be the highest if the market actually goes down into this 10, and you will only basically realize this big profit down here only when it's around expiration date. So for the put ratio spread is very different from the strangle, because the strangle, first of all, it has both-sided risk, right? You have the risk to the upside, you have the risk to the downside. Whereas for the put ratio spread, you see there's absolutely no risk to the upside. So the market can keep going up for all I care, and then I'll still just get the premium which I receive for selling this put ratio at the start. But as it goes down, you see, there is an opportunity for me to make much more than the credit I receive. And then, but if it passes past this break-even point, then that's where this put ratio spread will start to lose money. So before it can actually start to lose money, I want to make sure that there is a chance for me to make a lot of money. So this is pretty much a very defensive move. So for the put ratio spread, what I did is I basically placed the short strike down here at where the expected move is. All right, so this is another way for you to trade the expected move. So the put ratio spread, what I did for here is I try to put on as many trades as possible. And the difference between the put ratio spread and the strangle, one thing is that the put ratio spread is a slow spread. So that means I want to hold all the way to expiration because I want to have a chance to hit this big profit zone down here. All right, so for this, I actually traded on the XSP, which is the S&P 500 mini SPX options index. So for this, there is no chance of early assignment because this is European style options. So basically, all your profits and loss will be realized only at expiration, and this is a cash settlement. All right, this is a cash settle option. That means there is no assignment of shares at all. So once the option expires, right, so they will calculate whether you are in a profit and a loss, and everything will be settled in cash, right? So if you're lost, they will take the money out of your account, and if you're in profit, they will just put the money into your account.
How are you?
Welcome to Chicago.
I really
Out of the woods. You haven't heard about talking to see. I remember. I think it's closed. Well, that was just totally cool because, especially your degree is in finance, right?
Yeah.
Yeah. So if I can engage someone in the world of finance, like I feel like that's one of the coolest things about what we do.
Yeah. And I was shocked to know that like I was going to be able to get a response from you and you were given this quick and responses within the next day or two.
Take us through the kind of like discovering Tasty and then
Yeah, absolutely. So I mean, I was always like super interested in finance. I came across the Doe channel on YouTube, and they were kind of just describing the basics of options trading, and it was the first time I had even heard of it. I'd been familiar with stocks, but really that's it. And then I just kind of dived deep into those videos, and they were sort of explaining it in a way that I had never heard of. Right, you can make money without actually predicting, the direction of, XYZ stock. And that kind of, whatever reason, just triggered a light bulb in my head. So I just kind of went down that rabbit hole. And then eventually, I was also like pretty passionate about politics at the time as well. And as you know, Dylan, he did his time at CNBC and Bloomberg, MSNBC.
Yeah.
And then I found him on your network. And I was like, wait a minute, what is Dylan doing on Tasty?
Yeah.
And that's how I discovered Truth or Skepticism.
Did you ever see Dylan's rant when he got fired?
It's one of my favorite videos on
isn't it?
YouTube. If anyone hasn't seen it, just YouTube Dylan Ratigan MSNBC rant. It's incredible.
Yeah, it's great.
It's absolutely incredible. And so, yeah, I mean, he played the role of the skeptic, and I was in his camp at the time. I kind of adopted the philosophy at that time that, markets are efficient, and the retail trader has to be a passive investor and just kind of buy an ETF and sit and wait, right? I didn't see another alternative.
Well, also don't forget, that's also, at that point, you're impressionable. You're a byproduct of kind of very traditional academia.
Right.
So it's not like, you're not, at that point, you're not thinking outside the box.
Right.
You're kind of in the lane of every other, you're what are you, 22 or something at that point?
Yeah, basically 22 at that point. I'm an undergrad studying finance, so everything's pretty much traditional by the book, CNBC.
It's a regular curriculum.
Exactly.
Yeah.
And so, I just kept following that. And eventually, you changed Dylan's mind, and I kind of, just
It took
watched.
me like 10 years.
I know,
He's
but I watched
stubborn.
you pick apart his arguments, but he articulated his arguments in a really good way, and you guys had a lot of really great discussions. And at that point, I was like, okay, this makes sense. He kept saying, present fear of future uncertainty is fundamentally overpriced.
Yeah.
Hence the reason the insurance market exists. Hence the reason they offer you warranties. And so I thought if I can play that role in financial marketing, and just kept watching Tasty more and more, and then saving some money.
Yeah, it's your path is very traditional, but the cool thing about it is like that's what we're trying to do is to, somehow find a way to engage, people that were at the time, same thing, 22 years old,
Yeah.
just out of school, just to have a different mentality to develop in the world of finance, so that
Right.
so that the next generation, as you figure out what your career path's going to be, and as you work your way through, the world of finance through like this is effectively a networking event for you,
Right.
And over time, as you work your way through finance and you figure out how to, whatever turns you on, in this industry, you'll have a very different perspective. Like
Absolutely.
you won't be the guy that walks in and says, there's one way and one way only, and it's passive investing.
Yeah.
You'll be very familiar with strategy. You'll be very familiar
Right.
with all the different types of products.
Yeah.
I mean, you trade stock, options, futures,
Everything.
and everything,
Yeah.
and you gamble on sports too.
Yeah, and so definitely it breeds a different level of confidence when that when I'm talking to people about markets or trading, that I have that perspective from just something different and a different understanding rather than what you're seeing on like. Mainstream business media or kind of just what the traditional mindset is in finance. So
Yeah, we like people that come from obviously we like people come from engineering background. We also like people that come from kind of a more of a things that lead to quick decision making, like for example poker players or sports sports,
Yeah.
people that bet on sports, just because it's the way your mind, you're just looking for, the wonderful thing about financial markets is eventually you find your way to a much more efficient marketplace
Right.
than like you mentioned, like a political marketplace or
Yes.
a sports betting marketplace where the markets can be quite wide
Right.
and very inefficient and actually quite small,
Yeah.
as opposed to like now you're trading S&Ps where the market
Yeah.
is multi-trillions of dollars.
Right.
You can't move it.
Incredibly liquid, incredibly deep. So
Yeah.
it's a lot of the same, but you just have a lot more product diversification, and but it's the same sort of risk parameters and risk management. And anyone who has that sort of risk appetite, they'll find a love for financial markets in the same way they find a love for sports betting or anything along those lines.
Exactly. So let's take a walk through kind of your story, your timeline.
Yeah.
Because that's the fun thing about
Yeah.
the Rising Star segments is that we give a little background and then kind of get into a little heavier piece about strategies and how kind of, I mean, the nice thing about your essentially what you've done here, and I care about more on a percentage basis, things like that. But if you can turn $90,000 into $140,000, essentially what you've done is you've generated a 50% return on capital, which is obviously quite impressive in a relatively short period of time, and that's only like the first. Because you're young, it's the first baby step to wealth creation.
Right.
But it teaches you so much.
Absolutely.
And like the lessons learned around that, about risk and about strategy. It's the stuff that you will use it for the rest of your life.
Absolutely.
Like for the next 40 years, you'll be doing like till you're 67.
Absolutely.
You'll be doing the exact same stuff at different levels. Different levels of commitment, different levels of engagement, different levels of everything. But you'll be doing the same stuff. It's all variation.
Yeah. And so I started with a small account.
Yeah.
And
$5,000.
$5,000. Yeah. And
I
didn't know much.
Where'd you scrape together $5,000?
I was at the time. I was working at the time, so I had some money I had saved up. It wasn't much, but that $5,000 was pretty much everything I had.
Okay.
So I put it into a Tasty account. I knew very few basics. I basically understood that you were primarily trading strangles, and like the idea again of being able to make money without having to pick direction was really attractive. So like I went in and I just started selling a couple naked strangles in a $5,000 account, and it worked at first. I think I did like EWZ, which is like the Brazilian ETF, and then it worked at first. Selling a couple primarily trading strangles, and like the idea again of being able to make money without having to pick direction was really attractive. So like I went in and I just started selling a couple naked strangles in a $5,000 account, and it worked at first. I think I did like EWZ, which is like the Brazilian ETF, and then just a couple stocks, and I'm like, this is easy. I can't believe I found this. I just need more money so I can keep compounding. And then I actually remember it. I think it was EA. And at the time, they had earnings, and I had a strangle. I don't remember like the details, but at the time, Fortnite, which was developed by Epic Games, had exploded, and the stock had went parabolic on me. And at that point, I did not follow any mechanics. I was just short strangles, and the stock just blew through my call. And I kind of just sat there, and I'm just like, okay, whatever. It's going to come back down. I mean, this is a ridiculous move. It must come back down. And it just never did.
No such thing.
And so I didn't roll up. I just sat there and waited.
Yeah, the old wait for the mean reversion. It doesn't happen in price.
No, it does not.
Yeah.
And so it happened with that. It happened with like one or two other stocks. And at that point, I realized like, okay, I'm missing something here. And I kind of just blew up that 5,000, honestly.
Okay, that's fine.
So, but it was a lesson, right? And it made me like realize, okay, just take a step back, look into the content more, understand, learn more, and that's what I did. And in the meantime, I was just working, and I was able to save more money and just continue to consume your guys' content and learn more about markets and the strategies and kind of the mechanics. And so.
I mean, we're currently doing a tour around the country called the Bad Trader Tour.
Yeah.
And the whole purpose of the Bad Trader Tour is to talk about all the horrible trades we've made over the years, not just in like, options or stocks or futures, just in general, like in life.
Yeah.
And how it's all part of, a much bigger learning experience. It's kind of part of, people that don't take risk. I mean, you've heard the expression, the biggest risk you can take is not taking any risk, but people that don't take risk really end up, it's a huge challenge for them because you can't all of a sudden wake up when you're 45 and you have 2 kids, or you're
Yeah.
55 or whatever,
Yeah.
and you're all of a sudden decide, okay, now I'm going to start taking some risk in my life.
yeah.
You'd be like, where the F did my life go?
Right.
And so so this is the time to do it. You have no risk.
Right.
I think I said to you in an email notes because I think you said something to me. I kind of remember. I got to go back now. Now you may want to go back and look at the emails, but I think I said to you, "Listen, you're young. What do you don't overthink this."
Yeah. I mean, there's definitely been some stressful moments, and I'm an overthinker just naturally, and so
Everybody kind of is. Human
yeah.
nature puts everybody as an overthinker.
Absolutely, yeah.
But the good part is you're a very fast decision maker.
Now I am.
Now you are. Yeah.
Now I am. Yeah.
So eventually, you blow out of the $5,000, whatever it is.
Yeah.
And eventually, but you keep studying and you keep playing along.
A couple obstacles here and there.
Yeah, a couple obstacles. Obviously, you're starting to build a career. You're doing
Yeah.
whatever, and you start to save up some money.
Yeah.
And you get to the point where you're like, okay, I feel like I'm ready to re-engage.
Yes.
Okay, so
Yeah.
take us through.
Yeah, and I've always felt like it was more challenging to be able to be successful implementing these strategies with a smaller account, like a Tasty Bite account. And so I did want to.
It's totally hard. It's much harder.
You just have access to a lot more products and strategies with more money.
Yeah, it's totally hard.
Implementing these. Yeah, and I've always felt like it was more challenging to be able to be successful implementing these strategies with a smaller account, like a Tasty Bite account. And so I did want to.
It's totally hard. It's much harder.
You just have access to a lot more products and strategies with more money.
Yeah, sure.
And so once I had more money, I saved up money through working, and I had $90,000, and I went in with the account, and I said, I'm going to do this. I'm going to risk, and if I lose money, I lose money. It's okay.
Yeah.
And so I went in with $90,000. I stayed mechanical. I made sure to just keep my deltas in line at all times, and really just understand that sizing is going to be the key to staying alive. Right?
So let's talk product. The thing I like about your story is that you truly are product indifferent. Like you don't give a crap. Like for you, it doesn't matter.
I don't know where anything is going at any point in time. Right? Like I don't feel confident in my ability to
Didn't teach
predict
you that at school, by the way.
Absolutely not. Yeah, and I still have arguments with some people, like my brother. Like he's very kind of Warren Buffett fundamental.
Sure.
You got to figure out where this business is going.
Ask him how did he do that? When he has the answer to that, I'd like him to tell the rest of the world.
But so I'm pretty much product indifferent, and so I really just wanted to adopt premium. Premium selling strategies because I thought that's where the true edge lied.
Yeah.
And that's premium selling strategies because I'm pretty much product indifferent. And so, yeah, I really just wanted to adopt premium selling strategies because I thought that's where the true edge lied. Yeah, I really just wanted to adopt premium selling strategies because I thought that's where the you got to figure out where this business is going.
Ask him how did he do that? When he has the answer to that, I'd like him to tell the rest of the world.
But so I'm pretty much product indifferent, and so yeah, I really just wanted to adopt premium selling strategies because I thought that's where the true edge lied.
Yeah,
and that's kind of what I did. I basically begin just selling strangles. I did it in some individual stocks, and I had some success, and I had some failures.
Yeah.
And I kind of eventually moved away in terms of individual stocks towards the indexes more. And I think you've noticed there's this outlier moves quite a bit. You have the Nvidias of the world, the Zooms of the world. It was a crazy time over the last couple of years.
From when you started and ramping up, let's say in 2020, to 2023.
It's a lot of big moves.
Yeah.
So
the Zoom's still my worst trade of the last 3 years.
So I'll still trade them, but I'll size them more accordingly, and I'll just adjust much quicker.
Got it.
But I transitioned to trade more of the index products for the futures.
Like
both
what? Like what?
Like NQ, ES.
So you're trading futures options.
Yeah, futures options, yes.
Got it.
The E-minis typically, you get the leverage and
You just like the span margin.
I like the span margin.
What do you think your ratio is of futures options to listed options?
I would say 60-70% index options.
And what would you
options.
say your defined to undefined ratio is?
I'm always undefined.
Okay.
I'm not a big defined risk trader.
Yeah.
I mean,
I understand.
Yeah. So I like to be just naked for the most part.
Okay. Good.
So yeah, and I think the index futures are obviously much more liquid, and I think the moves are easier to manage. You don't see.
I totally agree.
Yeah.
Much easier to manage on.
But I'll trade more than just the stock index futures. Like I'll trade ZB.
Sure.
I'll trade the short end ZT as well. There's not really a deep derivatives market there, but I'll trade it statically, like directionally.
Yeah.
Especially lately, it's been moving quite a bit.
Yeah. No. The 2 years.
Yeah. I'll trade the short end ZT as well. There's not stock index futures. Like I'll trade ZB.
Sure.
I'll trade the short end ZT as well. There's not really a deep derivatives market. I'll trade it statically, like directionally.
Yeah.
Especially lately, it's been moving quite a bit.
Yeah. No. The 2 years been crazy actually, and same with the 10.
Right.
Way more so than I think I spent 10 years not watching it make three. Not even trade 3 ticks, and now it trades like 3 handles.
Exactly.
Yeah, it's crazy.
So, it's exciting. I'll dive into currencies, sometimes commodities, but not as much. So I would say 60-70% are in the index futures.
How much of your day do you spend watching markets?
So I work from home, and so I always have the screen up. I'm not like trading much. I'll make a lot of adjustments throughout the day, but I'm constantly monitoring, even after hours. I mean, I have I'm a junkie like you.
So
now.
you're a
like,
junkie. Okay.
I wake up first thing in the morning.
Okay.
I'm checking.
Yeah.
I'm checking ES. Before I go to bed, I'm checking ES.
You do understand that you're dead. I mean, you're basically this is your life.
This is it.
It doesn't matter where you are. You could be traveling, and you could be traveling in the middle of you could be in the middle of India. You could be somewhere in China. You could be God knows where.
I joke with my fiance. I tell her if I wake up from a coma, the first thing I'm going to ask you is where is ES.
Yeah.
So
you're gonna be logging on to to your phone and just saying, hey, where is everything trading?
Yeah. For
Okay.
sure.
So when let's say you're doing, let's use ES as an example.
Yeah.
And what delta are you selecting for your short strangles?
I'll usually go like 20, 30 delta.
Yeah.
It depends on where vol is. Honestly, in low vol environments, I'm closer to like 30, 40 sometimes.
That high? Okay.
I need a good amount of credit to collect, and I don't typically hold the positions for super long. I will sometimes, but when vol's already low, there's just not, as you guys say, that much meat on the bone. So
No.
even when it's coming in, it's not coming in much.
Are you mostly doing? Are you tweaking them to have a little delta, or are they mostly delta neutral?
It depends. It depends where my overall portfolio delta is at the time, and for the most part, I'll be delta neutral. Sometimes I'll be a little bit short delta because when we're short vol, we're synthetically long, and
Right.
so I'll try to skew it a little bit. You obviously get typically paid a little bit more on the put side.
Yeah.
So I'll typically skew it a little bit short delta. I don't want to be long delta and have vol exposure at the same time too often.
And let's just use an example just for
Yeah.
just example's sake. Let's say you sold 25 delta on both sides, puts and calls. Obviously your puts are going to be richer, but you sold
Yeah.
25 delta.
Yeah.
Now all of a sudden, the market has a move. Let's just say let's say the market goes a little higher.
Yeah.
So the calls are challenged.
Yeah.
So now the call delta goes up to 40 and the put delta goes down to 12 or 15.
Yeah.
Okay, what do you do?
Potentially rolling up the put. Not always. Sometimes I will add deltas a different way, either by like buying a call spread.
You will. Okay.
Yeah. Sometimes I'll buy a call spread, and then sometimes I'll finance that call spread by selling a further out of the money call. And that will be put on for technically like a delta neutral position, but I don't really mind that, right? So like if I have a position on where I feel like
It's
I'm
like
gonna
a ratio spread.
Yeah, a ratio spread, right? I like having the flexibility of if the market moves a little bit, I'm going to make money. As long as the market doesn't have a big move, I'm okay. And so I like ratio spreads for that reason.
Are you generally like a mental stop guy, or are you a hard stop or a mental stop?
I don't have mental stops or hard stops. I'm gonna kind of just go with the.
So you're always watching. You're
I'm
like
always
me.
watching, and I'll make decisions on the fly. I'm not as systematic as maybe I should be, but I think I like it better that way. If I have more flexibility, but.
But you sound like you're pretty mechanical.
I mean, when it comes to delta exposure, I have my limits and lines, but also it depends where the market's trading. I mean, if the market is crashing or declining significantly, like I'm comfortable holding.
The one difference, because we talked about sports earlier, but the one difference between sports betting is you have to be directional.
Absolutely.
I mean, it's a directional play.
Yeah.
And the stock market is has this non-directional component. You know, that
Which
where
is the
you
beautiful
live.
part about it.
I know, right? But it has that middle ground, which is essentially that non-directional window.
Yeah.
And that's the difference. I don't think a lot of people get that.
Yeah, I would say most people definitely don't get that, and I like having the ability to like have my profit tent somewhere in the range of 5% up, 5% down. I'm okay, right?
Yeah.
And just
Are you mostly doing kind of like the the 40, 45-day stuff? Or are you going
Primar-
shorter duration, or what are you doing?
Primarily 40, 45 days.
Okay.
And then usually closing 21. Sometimes I'll let
So
it
you're
go down.
sticking pretty close to Tasty Mechanics.
Yeah, pretty close. Sometimes I'll let it go a little bit closer, 14 days, but around Tasty Mechanics. I will go longer. I like to hedge by going longer out. In other words, like I'll do a ratio spread in ES where I'll buy a put spread pretty wide, and then I'll sell a really far out of the money put.
Yeah.
So the market ES is at like 4,500 right now. I can buy a $200 wide put spread, 4,400, 4,200, and then maybe sell the 3,500 put, and I could be like 80 or 120 days away, and I can put that on for maybe a credit or a small debit, and I think it's a pretty good hedge against vol expansion and just market declining, right?
Yeah.
And
No,
if the market,
I like those spreads.
yeah,
They're very typical for floor trader spreads, by the
yeah,
way.
and
Yeah.
if my short put is tested at the end of the day, like at that level, for the most part, I'm pretty comfortable, holding and then being long at that point, right? And that's what's beautiful about shorting puts and options, right? And that's kind of what my go-to strategy is.
Do you have anybody that you can talk to?
Not in this way. Like I said before, I'll talk to my brother, and he trades and he invests, but because he has kind of more of that traditional philosophy,
Yeah.
we don't really get into the weeds of it.
Yeah.
But I'll buy stocks too, right? Like
I understand that.
you
I'm
sucked
saying-
me into long China a long time ago.
It hasn't been that bad.
It hasn't, honestly. I mean, I waited a little bit longer than you did, luckily,
It
but
worked
it hasn't.
I'm okay in there because even the Baba stuff worked out today.
Yeah, exactly. So long Baba, definitely, and so yeah, I'll talk to my brother. But outside of that, nothing like getting into the weeds of it at all, honestly.
Yeah. It's tough. And do you go back and talk to anybody that you went to school with or professors and that kind of stuff? No, probably not.
Not really. I just don't think they can honestly relate. So yeah, it's lonely as a tasty trader out there. I joke with my fiance. We've like humanized the market. We call it Mr. Market. So she'll ask me how it's doing every day, and sometimes it's bad, sometimes it's good. But I don't really have much to really discuss with.
Where do you see your like what's your game plan like trading? Just more of the same? I mean, is that for me kind of nothing ever changes, but I'm just curious, like, what are you saying? I mean, do you want to, at some point, are you thinking, okay, I mean, I'm going to stay on this path of, self-directed, manage my own money and stuff like that. I saw, on the bio, you're starting to manage, your dad's account. Which is the first step, by the way, of. And the fact that he trusts you to do that, that's pretty damn good.
Yeah, he does. He does. So credit to him for instilling the confidence.
Yeah.
Also, believe it or not, I got my fiance's mother. She allowed me to invest some money for her as well. So I'm just sort of building the confidence. It's a little bit more challenging and stressful to manage other people's money.
Managing your own money is I'm not gonna say it's a piece of cake, but it's very easy to
Mentally, it's
rationalize in your head.
Right.
When you start managing other people's money, it's very difficult. It's different. It's a different mentality.
Absolutely.
Because it's not because you know that they're never going to understand.
Exactly.
Yeah.
And so
we've managed money in the past. We did okay, but we didn't like it because it was very hard for us
just
to.
don't feel the same freedom and flexibility.
Yeah.
So, but I mean, in terms of the future, I think going down that path, I would like to manage money for other people. I think that's definitely something I want to continue to do. I also just really enjoy talking about financial markets and talking strategy like we are today. So, I mean, I like even creating content, honestly, and trying to teach people. It's difficult. But
Your level of articulation about what we do is great. And so, like, you should be proud of yourself. I mean, like, you talk the talk like you've been doing this for, like, this is it's cool for me to see or for me to hear, because I feel like, like this is a lot of stuff you're talking about is stuff that we've been, repeating and preaching for, for over a decade. And it's nice to see it. And it's nice to see you be able to articulate it and at the same time be able to execute it. So, because we've always argued that like what we do is very practical,
right?
The reason I don't like the macro stuff so much is because I don't know how to apply it. Like we were talking about the CPI, this morning and stuff like that, and I'm like, I don't care. Because I don't even know what to do.
Believe it or not, like I'll listen to quite a bit of like macro podcasts and fundamental kind of like commentary, and I'm looking for something, but 90% of the time there's nothing. I mean, at the end of the day, it's like, what's the trade? What can I do with this information? And more so than not, it's extremely challenging to take, you know, a macro like thesis or fundamental thesis and really channel it into a trade and have any additional confidence about it.
I just don't. I think that for some reason, like traditional financial media still believes that if you can articulate some form of like macro finance, like
Yeah.
that you understand finance, when I think that is the most meaningless thing in the world. And when you have to be able to articulate actual strategic mechanics and trade
Yeah.
mechanics, and then,
Yeah.
then you have something of value.
Yeah. I'm on Twitter quite a bit, and so a lot of people on Twitter, like FinTwit, will post, you know, their macro thesis or whatever, and my response is always, okay, what's the trade?
Yeah, exactly.
Tell me what you're doing with that. I don't need to know what employment is going to be or CPI. Tell me how to make money off of that information.
So what do you think about, you know, markets? This has been a pretty, you know, obviously a pretty strong year for
Yeah.
stock market and
Yeah.
and so far.
Yes.
You know, and there's some of the other markets, no, not so much.
Yeah.
Do you have a specific, like, I mean, are you trading digital assets as well?
A little bit.
Just nibbling?
Just nibbling. I want to see a pullback in crypto. I mean, we have seen something, but I want to see a pullback, and then I'll try to get some exposure to it, but not too actively. I mean, I got kind of hurt shorting the NASDAQ this year. I mean,
Everybody did.
Yeah, everybody did.
Yeah.
But it hasn't been. I waited too, like you did. I waited quite a bit before even getting any short delta in there. I think the market's probably chopped till the end of the year, honestly.
That's exactly what I think. We're going to be a lot of chop across the board. So when you look at markets today, like, you know, halfway through 2023, or a little past halfway through 2023, is your approach? It sounds like it is, but is your approach really just, I'll do wherever there's opportunity, I'm there.
100%. Wherever there's volatility to sell, I'll sell it. And that's kind of the name of the game at the end of the day, right? If I just want to be short vol, I want to be collecting data, and I'm pretty confident in the end, as long as my size is in check, I'll be okay.
When we were on the trading floor years ago, was everything was based on noise.
Yeah.
So you walk on the floor, wherever the noise is, that's where you want to go.
It's so much easier to make money.
And so it didn't. So people would go like, "What do you mean wherever the noise was? You don't even know what's trading." I'm like, "I don't need to know what's trading.
It doesn't matter.
It doesn't matter exactly.
Yeah.
I just need to know where's the noise."
Exactly. Yeah.
And because with noise comes opportunity, and essentially, when you're in front of a screen, you don't hear the noise, but you can sense it.
You can see it. Yeah. I mean, that's why it's much more challenging for me to make money in environments where we're grinding higher and vol is low, because as you know, there's not that much noise, and so.
How often do you think you adjust your positions?
I'm doing something every day, almost every day.
Good.
You know, almost every day. So
Yeah.
I'm not always entering new positions, but I'm at least adjusting almost.
How many different positions do you have on at any one time?
Probably 15, 20
15.
maybe.
That's about right for your account size.
Yeah. Probably
Yeah, I was going to
15,
say,
20.
you know, 15 to 20 is probably good for your account size.
Yeah.
How much of your capital are you using right now?
Right now, I'm probably 40%. I mean, we've had a little vol expansion. It's right around
That's about-
17 right now.
That's
so
about perfect.
I like it where vol is here right now. I'm much more inclined to trade more now. When we were getting down into the 13s and 14s, it's much more difficult, honestly.
I know. Don't worry.
yeah.
I've traded when it goes down to 9. Okay, it's like
I don't want to trade in that environment. I don't even. I don't
you
know
don't
how.
want to, but you don't. The reason you do is because
else
it's
can you
very
do?
hard to lose. Like nothing happens.
Right.
You know, like everybody wants to trade when it's 70.
Yeah.
But the other side of that is that you have some ugly moments. You know, when
Yeah,
vol
exactly.
70 is as well.
I mean, luckily, I wasn't trading it during March of 2020, because that's something that keeps me up at night. Is just a massive VIX explosion, and I'm not sure how I'll handle something like that, because I haven't experienced it yet.
You'll stay small. You've learned to stay small, but March of 2020 was really hard.
Yeah, I mean,
But again, that doesn't happen that often.
Yeah, exactly.
You know, so
you can't prepare for it, really. I mean, what can you really do?
That's why they call it an outlier move, or a 4, 3, 4, 7, 10 standard deviation move. There's nothing you can do.
Yeah.
You know, you just have to stay small and hope you weather the storm.
Exactly.
It's just like any other. That's what keeps the markets honest.
Exactly.
This was a great discussion.
Yeah, absolutely. I really appreciate your time and opportunity. Some money I had saved up. It wasn't much, but that $5,000 was pretty much everything I had.
Okay.
So I put it into a Tasty account. I knew very few basics. I basically understood that you were primarily trading strangles, and like the idea again of being able to make money without having to pick direction was really attractive. So like I went in and, I just started selling a couple Naked Strangles in a $5,000 account. And it worked at first. I think I did like EWZ, which is like the Brazilian ETF, and then just a couple stocks. And I'm like, this is easy. I can't believe I found this. I just need more money so I can keep compounding. And then I actually remember it. I think it was EA. And at the time they had earnings and I had a strangle. I don't remember like the details, but at the time Fortnite, which was developed by Epic Games,
Right.
Had exploded. And the stock had went parabolic on me. And at that point I did not follow any mechanics. I was just short strangles and the stock just blew through my call. And I kind of just sat there and I'm just like, okay, whatever, it's going to come back down. I mean, this is a ridiculous move. It must come back down. And it just never did.
No such thing.
And so I didn't roll up. I just sat there and waited.
Yeah, the old wait for the mean reversion. It doesn't happen in price.
No, it does
Yeah,
not.
yeah.
And so it happened with that. It happened with like one or two other stocks. And at that point I realized like, okay, I'm missing something here. And I kind of just blew up that 5,000, honestly.
Okay, that's fine.
So, but it was a lesson, right? And it made me like realize, okay, just take a step back, look into the content more, understand, learn more, and that's what I did. And in the meantime, I was just working, and I was able to save more money and just continue to consume your guys' content and learn more about markets and the strategies and kind of the mechanics. And so.
I mean, we're currently doing a tour around the country called the Bad Trader Tour.
Yeah.
And the whole purpose of the Bad Trader Tour is to talk about all the horrible trades we've made over the years, not
Yeah.
just in not financial markets. Is eventually you find your way to a much more 2022 is the reason you are here as a rising star.
Right.
So you
One portfolio.
see that?
Yeah, that's right.
Okay, and you say, you go like, all right, let's give this a shot.
Yeah.
Okay, so take me through. Let's go 2020, because 2020 was kind of a year like, none of us are ever going to forget.
Does the world economy come to a complete stop?
We're seeing something that we've never seen before, and in the process of seeing that, people are scared.
Yeah, hell yeah.
And they should
and
be.
rightfully so.
Stuff is in case we're crashing. The rest of the year, you're in your.
That's right.
So did you survive 2020?
I did. I survived. I'm still here. So just like you asked for, I'll tell you exactly
Okay, good.
what I did
That's
through
good.
that time.
Yeah.
So before 2020 happened,
Okay.
after the flash crash of 18, right, it
Yep.
was just straight up from there.
Yeah.
And it was a lot of rolled positions that I had left over by the time early spring of 2020 arrived. So it was a lot of rolled naked calls, a lot of call spreads that I had learned how to roll, but not like I did through 2021, which we'll talk about later.
Right. But you're saying in 2020, what you had learned was to roll positions forward.
Yeah, it was a segment that you did with Tony. You guys were talking about anatomy of a trade with Amazon, and just like I had known the whole time, you could roll up the untested position to collect more credit on like an iron condor, for instance. But I did not know that you could roll out the long wing and roll out in time.
Okay.
So I started doing that with these leftover positions, and through 2019, and then that really just it saved me because I learned that you could just get a little bit more credit, roll things out. You're taking more risk, but I just at the time I was just willing to take
You're young.
that risk.
I mean, you're young. I mean, I'm serious. You are young. You're young. You're successful. You can take a little bit of risk. It wasn't like a crazy amount.
Yeah.
And that was going back to the whole Karen the super trader discussion. I mean, that was her approach on losing positions, which is, hey, push them out, roll them down and out.
Right.
Essentially down. If you short puts, roll them to lower strikes and roll them out in time until you can pick up a credit. And same thing on the call side, roll it, up and out.
Yeah, so the crash of 2020 helped me. It brought all those positions that were deeply in the money, it brought them out of the money, made them profitable. And so I was able to get out of all those trades that had been just a graveyard of rolled calls and call spreads. And so by the time March 2020 rolls around, I'm doing what I think is I'm doing well. I think I'm doing pretty good. And the bond market starts going crazy at that time. So it was around then that I started trying to short the 30-year bonds.
Oh, so you're doing. You have a relatively small account, and you're doing the ZBs.
Just one contract.
One contract of ZB options.
That's
Yeah.
right. And well, no, actually, no, just short the actual future.
Oh, short the future. Okay.
But at that time, I had already cashed out my 401k from a previous job. So this is about in a $30,000 account
So
now.
you took your 401k and you rolled it into a regular margin account.
Yes.
Okay, because most people, when they cash out their 401k, they'll roll it into like an IRA or something like
No,
that.
yeah, I did regular margin.
Yeah, okay. I like that because that's a power move. Because at your age and where you are in life, that's the whole concept of really owning your own risk and owning your own future type thing. So I like that.
Yeah, they seem to hamstring you. I can't do what
Yeah, you can't do
I
anything.
want to do.
Yeah.
I figured I'd rather take the tax hit and just do what I want to do, and
Yeah.
and it obviously has helped.
Yeah. Okay, so you have a $30,000 account.
That's right.
We're getting to 2021.
This is still so 2020. The bond market's going crazy.
Yeah.
I figured that the best way to play this bounce would be to short the bond market, because I figured while the stocks were going up like they did, the bond market had to cool down sometime.
Okay.
And it didn't. And I remember there was one day I woke up and the bonds were at 191. They printed at 191.
I remember the day.
And I just wish that I think it was like March 6th or something like that. It was a Friday, and I just remember wishing I had more money, because it was like there's times as a trader when this is just a gift that you've got to do something. And I know you know what I'm talking about.
Yeah, because that actually, not only that day was my birthday.
Oh.
And I remember that day, and I was short the bonds as well.
Yeah.
So yes, I remember it like it was almost like it was yesterday.
Yes. So through 2020, the bond trade cooled down for me. It ended up being okay. But I didn't know. You don't know anything, but
Right.
I just had a obvious hunch that this market cannot sustain the rally that it was on. So I took that position in bonds, and I took that money and rolled it into a short position and just a few micros, the mini NASDAQ, the micro NASDAQ futures, and the E-minis as
Okay.
well. Not the full contract, just the micros.
That's fine.
So I had a really short, and a lot of, again, rolled calls and call spreads
Yep.
that became in the money in 2022, just like what happened to me in 2020. So I took
Yeah, but
that
hold on.
knowledge.
Before you get to 2022.
Sorry.
So you're at 10,000 or whatever it is you open an account with. You cash out of your 401k.
Right.
You get it up to whatever, 30,000-ish. Okay. So you have 30,000 in a margin account that you're playing with. You take that 30,000 up to what, about 60 or something?
Yes.
Okay, so you did good. So you basically doubled your money, and you're thinking, "Hey, I got this.
Right.
I'm kind of a genius. I mean, I'm just saying this is how our egos work.
Right.
Okay, I got this. If I can go from 30 to 60, I can go from 60 to 120 to 240,
Right.
to 480, the whole deal. And then in 2021, you got slapped, right?
That's right. Yes.
Okay.
It was another grind up year.
Okay.
Something that I still am I'm searching to learn how to handle that situation.
Yeah.
Which we're not in this year, but eventually we'll be there again, and I want to know what to do then. But
So 2021 is a tough year, and your count drops all the way down. So you go from the 60 to 30, and then you go from 30 all the way down to 17,000.
that's right.
So you basically lost 50%. You lost 50% and then 50%.
That's right. So yeah, 2021 was an up year. It was the same thing. I had a lot of naked calls that were left over
Yep.
from rolling up the untested side of
Yeah, we made new highs
strangles.
in the market basically.
I remember learning that it's more statistically better to trade both sides.
Yeah.
So if you're going to be short a put, you should be short the call as well and the
Yeah.
strangle. However, I feel like you have to be aware of what the market's doing. Like you have to have some kind of market
Sure.
awareness. Now I kind of know that in a crash like that, the rebound is pretty tough, and I probably won't be short
Yeah,
calls
because you
like
missed
that.
it in 2008 because you were too young.
That's right.
And you didn't really get that like that 2009-10 rally that
Yes.
and then the next 15 years. So you take your account. You did all this work now from 2019 all the way to the end of 2021, and you're below where you started from. Has to be a little bit discouraging, but on the other hand, you've learned something.
That's right.
Okay, so now 2022 is the reason you are here as a rising star.
Right.
So you start the year with 17,000. We make a high on January 3rd, first day of the year.
Right.
And for the rest of that year, you killed it into this year, and you've done great, and you've turned the 17,000 into 300,000.
That's correct.
Okay, now that's progress.
It's
That's
progress.
scale, that's repeatable scale, that's organic growth. And what did you do? Like what clicked? What happened, trade-wise? It couldn't just be rolls. And what happened? Like tell me, what kind of products did you trade? What kind of strategies did you use? When did you roll to keep your positions alive? Were you rolling for credits or debits? Like all these things.
No problem. I was for a call spread, for instance, I would roll out in time, and I'd expand the wings. So I would.
So let's
collect
talk
the
about
credit.
call spreads. So you
Yeah.
put on a call spread. Typically, how far out in time?
And the spread, for instance, I was for a call spread, for instance, I would roll out in time, and I'd expand the wings. So I would.
So let's
collect the
talk about
credit.
call spreads. So you
Yeah.
put on a call spread. Typically, how far out in time do you go when you put on a call spread?
45 days.
Okay, so you
Yeah.
stuck to the 45-day rule.
Yes.
How far out of the money do you like? What delta is your short call?
I go 25.
25. Okay, and then what delta is your long call?
I make it long. I make it wide enough so I collect as much credit as I kind of want to. Like,
Okay.
for instance, right now on a SPX call spread, for instance, I would want to collect 1,000 and take about 4,000 in risk.
Got
so
it.
like a
Okay.
$50
Yeah, so you're about
line.
80% probability of profit type
Right.
thing. Okay, got it. So you're right at that 20-25 delta.
Right.
If the market went up, were you rolling because the deltas changed, or were you waiting till you get to 21 days?
Waiting to get to 21 days.
Okay,
yeah.
so you were pretty consistent about that.
Yeah, and a lot of these were in products where you didn't have to worry about being assigned.
Like SPX.
Yeah, exactly. So SPX is great for that. I remember that segment with Bat. You seemed very perturbed that he was doing that, and he was obviously getting under your skin. But I understand why, because it is a low
He's never
probability.
gotten under my skin. It's all just show for the. It's just for the show.
Okay.
Yeah, he's never gotten under my skin.
Yeah, it is obviously a low probability of success method, but it gave me some hope. So what I was searching for in that time was hope, and it gave it to me, and it was able to sustain me through just a straight up market. So then when 2022 happened, all those positions again became out of the money.
Yeah.
They became profitable. I was able to close them, but at the same time, I was still short the micro futures.
Got it. And you had a big, 20% down move, which probably paid nicely.
Right, and then these subsequent rallies too. I was short. I was not long in those rallies. I wasn't positive delta, but I was significantly smaller in size.
Got it. But were you doing any naked options at all?
Not as much. No, when I had the $30,000 account, I was still trading naked. Tesla, for instance, like I remember I was very scared because the call strike was breached, and I didn't know if it was ever going to come down. It did. I got out, but it scared me more then than it does now. But now I love the futures. I love trading naked futures options too. But I don't know. Equities are just. Securities. Sorry, are. I don't know. I don't feel like there's enough credit sometimes.
You just like the additional buying power, but when you're over 175,000, you can go portfolio margin, and then
Yeah.
equities essentially become the same as span margin.
Yeah.
So it doesn't, now you're at the point where you can create, it's just more opportunity because basically everything looks like span.
That's right.
But so talk to me about those rollouts. So
problem.
were you always rolling for credits?
Yes.
So you always roll. So even if you were, let's say you were short a spread that was not in the money, but that went against you and you couldn't roll the same strikes for a credit, what would you do? If it was a call spread, you would roll it out to the next month or 2 months out? Or would you roll it up in price? Like how did you get a credit all the time?
I would roll out in time, keep the same short strike, and I would roll the long strike up.
Oh, so you would widen the spreads.
Yeah, widen the
So you end
spreads.
up taking more risk.
Exactly. Yeah.
Okay.
That's why you didn't like that.
That's right. That's exactly why I didn't like it,
Yeah.
because I'm not somebody that I don't like to add. You were betting that eventually you were going to be right, which is a totally reasonable bet. But since I've taught myself not to believe in mean reversion to price,
Right.
it scares me when I have to add risk to an already losing trade.
Right.
So I prefer not to add risk and try to either roll out same strike, so I don't have to put up any more money. As long as you can roll for credit, I don't care if I have to move it out further, move it up higher, whatever it is,
Right.
or pay a small debit.
Right. So that's what got me to where I am today, and I had
Have
to
you
make,
been able to keep the profits?
Yes, through this year, and then this latest up move has been not as detrimental as it could have been because I'm more diversified correlation wise now.
Yeah.
For instance, I'm trading other products like natural gas, oil. I've been trading oil for the past 2 years, and it's been amazing. Trading both sides of that market. But yeah, it's not bad. I think I'm gonna have a good year again.
That's
not
great.
not as good, but
Well, you
I'm
can't
not
have
gonna
a
be.
year where you make.
Right.
I don't even know how many. I don't even know what is that. That's 200. 300, I don't know, it's like 300 or 400%. I mean, your year was a crazy outlier last year, and you can hope to, it's going to, as you get more money, your returns will normalize.
Right.
But you can still, you can still have great years. It's just
Right.
not going to make 400% or 500, or probably not.
And that's not expected. And I hope the United States Treasury isn't expecting another generous donation this year as they got.
So how do you go back to work as an
Yeah.
engineer? Like how do you go back to your day job? Because you're trying to do all this.
Yeah.
This is a tough. I mean, because you're pretty active.
Right. It's actually not as hard as one might think. It's the market's only open a certain amount of time.
Right.
You don't have to do this staring at a screen all day.
How many
it can
trades
be
do you think you make a day, a week, that kind of thing?
Not that many. Maybe 1 or 2 a day right
Okay.
now. I'm not as active as I was a few years ago,
Okay.
but I'm still doing well though.
Yeah. But you're still participating every day, and you're watching the markets all the time.
Oh, absolutely, yeah. Yeah, it's working and doing this at the same time is very doable.
At this point, you believe it is repeatable.
Yes.
Yeah. I mean, so do I. Of course, we all do here. That's why we're here. But I'm
Yeah.
just, sometimes when you first start, it's very difficult concept to grasp, things like that. But do you think that are you going to try new strategies at all?
I'm trying to right now figure out how to do this with the top dogs portfolio method.
Sure.
So the 16, the very first one,
Yeah,
where
yeah,
you're
yeah.
long futures, short
Yeah.
options against them. That I really like that portfolio, and I've dabbled in it this year and trading uncorrelated products like gold and oil, natural gas, equities.
Those have been in good ranges. Everything
Yeah.
but natural gas. Everything else has been a pretty good range.
Right. Yeah. So that's what I'm learning to do now, or trying to figure out how to do as a core portfolio.
Thanks so much for making the trip up here to Chicago, and I hope you enjoy your stay in this amazing city. And I'm glad you could come to the office and share your story with us. I think everybody's going to love to hear it.
Yeah. Thanks for having me, and thank you for listening, because it's lonely out there as a trader. You can't share your successes and share your miseries with anybody else.
I know. That's why you just got to move here.
Yeah.
Thanks, Matt.
Thank you.
24
Yeah,
years old.
yeah, and I just made a little bit of money. I mean, for me, it was, and I was.
And you obviously, from 2012 to let's say 2016, you start. You're obviously playing the game.
Yeah.
You're investing more and more. You're getting a little. You're getting equity across the board. You're starting to get a little diversification, but you're mostly all buying stocks.
Yeah, or trying to buy one and then sell it. I thought that was the coolest thing. Now I don't, right? But I bought it for
The first scalp you ever make is the greatest thing in the world.
It's so cool. This is so easy. I can just
because scalping real estate, like we're flipping real estate,
Yeah.
like most people, that's a pain in the butt. You gotta
Very illiquid, yeah.
It's illiquid. You got closing costs. You got brokers. You got all this. It's a nightmare.
Right.
Flipping stocks on a platform for almost for free is the greatest thing ever.
it was
Yeah.
great. Yeah.
Yeah.
As long as I won.
As long as you win. As soon as you lose, you get mad.
Yeah.
And you get mad at yourself, and you get mad at everybody around you, and you're thinking to yourself, "Damn, I'm not supposed to lose." So, you tasted kind of options
Yeah.
around 2016.
Yeah. So same friend Steve, he hadn't found your platform yet, and he had told me, hey, you can buy a call on this. I think it was like PM or one of these.
What's this Steve guy doing?
I think he's still trading. I haven't
Okay,
talked
good.
to him in years.
Okay.
But he's like, hey, you can buy a call, and it went up, and I made like 100%. It was like went from $1 to $2 or something like that.
That's truly getting bitten by the snake. Yeah, got it.
It's like, this is so much. You don't have to use a lot of capital.